Hi everyone, welcome back to Saheb Academy. Today in this video we are going to understand and discuss about this adjustment entry which is called as outstanding expense, which is also known as accrued expense and unpaid expense or expense payable. Lots of different names are there, but it's just the same thing. Okay, so we are going to understand this in very much detail and we'll take a huge example which will span 2 accounting periods. We will start from the backstory, what happens behind this entry, this entire thing, and then we'll see adjusting entry being passed by the senior accountant, and then the reversal entry, and the next accounting period will begin. What normal entries will be passed by the bookkeeper, and then again the year will be ended, that next accounting period also, and then again senior accountant will pass adjusting entry and then the reversal entry, right? So we'll see this huge example and completely understand how does this outstanding expense works. Okay, so it will be a great example, but before going ahead to that, first we have to understand what we have seen in the previous video, right? So you have to watch this previous video, that is of adjusting entries, the conceptual video where we have discussed the meaning, why is it necessary, key concept behind adjusting entries, and then the real world scenario where these two concepts are not regularly followed, the accrual and the matching concept, because the accounting process is designed like that. Okay, the complex things, prepayments and accruals we call it, those things are left for senior accountants to handle. The normal cashier or the bookkeeper or the junior accountants do not 100% follow the accrual and matching concept. That's why adjusting entries are always required at the year end. And then we discuss basics of financial statements, right? After that, we saw the entire accounting cycle, how adjusting entries fit in, and the bookkeeper are instructed, as I said, you focus on day-to-day recording of cash transaction and credit transaction, routine transaction. Complex things will be handled by senior accountant only at the year end, okay, by passing the adjusting entries. Fine. And then we discussed the types of adjusting entries. We just saw this, and then we came to know that by following accrual and matching concept, we give rise to 4 main adjusting entries. 2 are related with expenses and 2 are related with income or revenue. We have outstanding expense, prepaid expense, accrued income, and then deferred income, right? Outstanding expense and accrued income are called as accruals popularly, and then prepaid expense and deferred income are called as prepayments or deferrals, right? So that's what we understood, and I told you we'll have one video on each of these adjusting entries. So that is what this video is on outstanding expense, right? And then we discuss the difference between accrue and due. These two terms we have in accounting. Accrue means to accumulate, right? To generate, to increase over the period of time. Due means the timing of payment or receipt, right? We discussed this in very much detail. Accounting happens according to accrual concept, but payment and receipt of cash or the bank balance, it happens when they are due, when the payment or the receipt is due, right? I gave you an example. Salary of a particular month is mostly paid in the next month. Salary of March will be paid in the month of April, maybe 7th of April or 5th of April, like that. So this will be called as the due date. And as per the accrual concept, your salary, the salary has been generated over here day by day as employee provides the service, isn't it? So salary entry should happen at the end of the month, that salary has become outstanding. So that will be outstanding expense entry, right? We'll discuss all this in the example, don't worry, but this is the basic idea about the accrue and due, right? So this was the previous video. Now let's get back to this outstanding expense video. Now, before moving on to the concept of outstanding expense and discussing that further, first we have to discuss one small remaining concept that we have, and that is of open transactions. It's really simple and straightforward. See here, open transactions are nothing but the transaction which have occurred, which have happened, but have not been completed successfully in the same accounting period. Okay, those are called as open transactions. Let's discuss what is a closed transaction then. Closed transaction is a transaction which is, completed successfully in the same accounting period. Let's see how it will happen. At least in a transaction, there will be 2 parties involved. You all know that, a seller and a buyer. Yeah, it can also be employer, employee. Yeah, so many examples can be there, but to simplify things, let's just say seller and a buyer. First, what happens is buyer comes to the seller and asks for something. So seller provides goods or services, and let's just say we are talking about a credit transaction. Okay, so he provides goods or services to the buyer. That's stage one. And then the second stage is seller will send an invoice or a bill to the buyer. Please, pay me my money. Buyer will accept the invoice and buyer will send the money, right? He will make the payment. So if all of these three stages, providing goods or services, sending an invoice, and then payment, if all of these three stages happen in one accounting period, then we say transaction is closed in the same accounting period. Okay, and if this is the case, then we can safely assume as a senior accountant that transaction is accurately recorded by the bookkeeper or the junior accountant or the cashier, whatever the case may be, whoever is handling the bookkeeping. Okay, the simple recording of transaction, the process from journal till the trial balance. Okay, so we can say that in the ledger transaction is completely recorded, as well as in the trial balance it is reflecting. Fine. Okay, so therefore no adjustment entry is required by the senior accountant, right? So that's the thing. But if the transaction is open means all the three stages are not happening in the same accounting period. Two stages are happening in a current accounting period and the payment will happen in the next accounting period. If that's the case, which will be there in most of the cases, then we have an open transaction. Okay, and we usually have lots of open transaction at the end of accounting period. So that's why at the year end, senior accountant has to come to pass the adjustment entries. Yeah, adjusting entries, which are called as accruals and prepayments popularly in these cases, right? So yeah, because three stages of transaction will fall in different accounting periods, and we will have a situation of accrual or prepayments. Is that clear? Let's just say, for example, we have a year over here from 2023 to 2024, which start from 1st of April 2023 and ends on 31st March 2024. Yeah, here in this month, let's just say in the month of March, a service is provided to our client, our customer, but we usually send the invoice at the beginning of the month, let's just say, of the next month. So in that case, invoice will be sent over here, yeah, in April, and then payment will also happen in April. That's the next accounting period. You see, stages of transaction are falling in different accounting period. So proper recording by the bookkeeper or the cashier will not happen. It will not happen. So at the year end, because we follow accrual concept, we do accounting as per accrual concept. So senior accountant will have to come at the year end and pass an adjustment entry of accrued income in this case, because we have provided the service, we have to receive the money, right? We have earned the income, but we have not received it. So accrued income adjustment entry will be passed over here. Don't worry, we have not discussed accrued income and all. We'll see that in that video, okay, whenever we will discuss the accrued income. But right now, this is the example. Okay, in this case, we have to pass adjusting entry of accrued income at the year end, and then reversal entry on 1st of April. That's the first day of the next accounting period, right? That's what we have to do. Yeah, so this is the case. Okay, open transaction. In open transaction only, there will be what? Accrual and prepayments happening. Yeah, in all of these cases, what will be happening is we'll be having open transaction, and they happen at the year end only. Yeah, at the end of accounting period. Is that clear? So this case was accrued income. Fine. So that's all regarding open transaction. Now let's just go to the main concept of outstanding expense, and then we'll see the example. Now see, here we have the concept of outstanding expense. It's really simple and straightforward, and you already know outstanding expense is also known as accrued expense or unpaid expense or expense payable. Lots of different names are there, but it's the same thing. If you see in any books these terms, then you have to immediately understand it's just outstanding expense. We know how to pass the adjusting entry. We have learned about it. Okay, fine. So let's understand the meaning of this outstanding expense. Outstanding expense is an adjusting entry that we pass at the end of accounting period when we have this situation. See the situation over here. It is an expense, outstanding expense. It is an expense which relates to an accounting period but has not been paid for in that particular accounting period. That's what outstanding expense is. Let's take an example to understand. Let's just say, for example, your company's year ends on 31st March. Okay, it starts on 1st April, let's just say 2023, and ends on 31st March 2024. And the last month's salary has not been paid, March salary. Why? Because understand, your company's policy is that salary of every month is paid in the very next month, on 7th of next month. Okay, so March salary will be paid on 7th April. That's the due date of the salary when payment will be done. But understand, in accounting we follow accrual concept. So as per the accrual concept, we will have to record the March salary in this current accounting period only. Yeah, this is the accounting period, and then year ends over here, then we have another accounting period over here, right? So this is a case of open transaction, is it not? Salary belongs to March, this accounting period. Employees worked for March, right? So salary was generated over here, it is getting paid over here. You see, stages of transactions are in different accounting periods. You can clearly see, isn't it? Here we said service is provided to customer, invoice and payment is over here. In this case also it's like that. Employees provided the service over here by working for you, but you are making the payment. Salary slip will be generated in the next accounting period. So what will happen? The bookkeeper or the cashier, they will not record anything regarding this transaction because they don't have the source document. They don't know about this, right? Payment has not happened. So they have recorded 11 months salary. Okay, from April till February salary of this accounting period they have recorded accurately, but March salary is not recorded. So as a senior accountant, we'll have to come, we have to see, okay, 1 month salary has not been paid, it is not recorded in the accounting record, it is not appearing in the trial balance. So we'll have to pass an adjusting entry of outstanding expense and then reversal entry and all. Okay, so this is the case of outstanding expense. It is an expense which relates to an accounting period but has not been paid for. Yeah, so that's why we have to record what? Adjusting entry of outstanding expense. So what will happen? See, understand, in the month of March, salary expense has been incurred. Salary expense has been incurred. What does that mean? Incurred. What is the meaning of that? The meaning is economic benefit is consumed. Employees have worked for our company. We have taken their service to generate revenue, isn't it? So benefit is consumed. So we have to debit what? Salary account. Expense have to be recognized. Expense has debit balance. To recognize it, to record it, to increase it, what you have to do? You have to debit. So salary account will be debited in this adjusting entry. Okay, and then we haven't paid, right? Payment will happen in April, in next month, in next accounting period. So right now on 31st March, what we will do? What we will do? On 31st March, what is the position? The position is we have to pay in next month, have to pay, right? On 31st March, you prepare the balance sheet. So if there is a position like this, we have to pay, that means that is a liability. We have to pay. So you'll have to recognize a liability. Liability must be recognized, a current liability, right? In the next month, we'll pay the salary, right? But on 31st March, it is not paid. It is a liability. Is that clear? So liability must be recognized, and here expense will be recognized. Expenses go where? In statement of profit and loss. And this liability, current liability, will appear in balance sheet under the head of current liability. Okay, so what is the impact on statement of profit and loss? The impact is what? If there will be a profit, then profit will be decreased. If there is a loss, then loss will be increased, right? On the other hand, total liabilities in balance sheet will increase, isn't it? Yes. So that's the thing. And expense has debit balance, right? To record, you will debit. And outstanding expense is what? It's a which account? Liability account. Liability has credit balance. To record it, what you will have to do? You will have to credit it. Is that clear? So the entry will be like this. See here, journal entry for outstanding expense adjustment, expense account debit to outstanding expense. Right now we are talking about salary, right? So salary account debit to outstanding salary. Let's just say we are talking about rent account. Rent of March will be paid in April. Let's just say we have an agreement like that. Okay, so what will happen then? What will happen? We'll have to debit the rent account. March rent should be recorded in March only. In profit and loss, it has to go. Then only we'll get the correct profit. So rent account we will debit and we will credit what? To outstanding rent. Let's just say we have a policy like this of electricity bill. March electricity bill will be paid in April. Then what? Electricity bill account debit to outstanding electricity bill. Is that clear? This is what you have to do. Fine. This is the adjusting entry. Is it clear? Okay, fine. Understood. Then what will happen in financial statements? In financial statement, it's really simple. See, understand. This expense has to go in statement of profit and loss. So in P&L, whatever salary has been recorded by the bookkeeper or the cashier, what has been recorded? 11 months salary has been recorded. Na? Right now we are only talking about March salary. 11 months salary has been recorded. So you will have to add this March salary with that 11 months. Okay, salary will be there. You will have to add what? Just March salary to that. Is that clear? So in statement of profit and loss or profit and loss account, add to the expense. Okay, whatever the amount is. And then in the balance sheet, what you have to do? You have to show this outstanding March salary in under the head of current liability as what? As outstanding salary. Show outstanding expense as a current liability. Is that clear? This is what you have to do in the current accounting period. In the new accounting period, what you have to do? In the new accounting period, you have to reverse this. Outstanding expense account to expense. Exactly reverse entry you have to pass. Here it is credited now. You will have to debit outstanding expense and you have to credit the expense account. Then this entry will be reversed. You will wonder, then sir, why did we pass this? We pass this because the effect should flow in the financial statements. Once financial statements are prepared, the purpose of adjusting entry is finished. In the next accounting period, we will reverse it. And then the bookkeeper or the cashier in normal transaction, they will pass normal entry. Okay, we'll see the huge example and you will understand. This is what will happen in the current accounting period. Is that clear? Simple and straightforward, right? See here, expense has been debited to record it. It's increasing. Outstanding expense is a liability. It has been credited to increase it, to record it. Is that clear? This exact opposite will happen and they will decrease. Is that clear? In the next accounting period. Fine. All right. Now let's move on to the big example to understand this process completely with the backstory and the entire thing. Okay, let's go to that example. Now see here we have the practical example of outstanding expenses. It's really simple and straightforward. And I have taken the example of salary only. So outstanding salary. Okay. So see here we have this practical example spanning 2 accounting periods. First accounting period starts on 1st April 2023 and ends on 31st March 2024. And then the next accounting period will start from 1st April and ends on 31st March 2025. Okay. So in the first accounting period, our salary was how much? 1,000 per month. I have kept the figures simple to make you understand the concept easily. So don't focus on the figures, focus on the process and the concept. All right. And then the next accounting period, salary was increased to 2,000 per month. All right. And then salary of every month is paid on 7th of the very next month. For example, salary of October will be paid on 7th of November. Salary of February will be paid on 7th of March. Okay, it's like that. The due date is 7th of the very next month. Fine. So because of this policy, this practice of the company, what will happen is at the end of accounting periods, there will be case of open transaction. The transaction will not be completed in the same accounting period. March salary will be paid in April. Here also March salary will be paid in April. So on both the year ends, there will be a case of open transaction. Is that clear? So because of this, we will have a case of accrual or outstanding expense. Is it clear? So if we zoom in over here, let me just show you. If we zoom in over here, then see this is the position. Yeah, March salary has been accrued. Salary accrues daily throughout the month, right? It accumulates, it generates as the employees works for us. Salary has been generated. If we are right now at 31st March 2024 at the year end, then the position is we have to pay salary to our employees. Yeah, this is the position, but we haven't paid it. It will be paid on the due date 7th of April 2024 in the next accounting period. The salaries of March will be paid in next accounting period. Payment is happening over here. So this is a case of open transaction. adjusting entry is required by the senior accountant. But before all this adjusting entry on all, let's understand what has happened, what has bookkeepers or the junior accountants or the cashier have done, how they have recorded. Let's understand that. See, every month 1000 has been paid, right? From 1st April till 31st March. 11 months salary has been paid to employees. So that 11 months salary is recorded by the accountant. See here. 12 months combined. Salary account debit to cash. Every month on 7th, they are recording salary to cash, who? The bookkeeper. Okay. So in combination, if we see, then they have recorded 11,000. Why 11,000? Why not 12,000, sir? Because understand, March salary, last month's salary will be paid in April. So that means bookkeeper have not recorded that salary. It has not been paid. The pay slip has not been generated. The source document hasn't come to the bookkeeper or the cashier. They don't have any source document to record the transaction. So it has been not recorded. Fine. Only 11,000 has been recorded. Is that clear? Fine. So in this unadjusted trial balance, only this 11,000 will appear. Salary 11,000. Clear? Bookkeeper has not recorded on 31st March 2024 that adjusting entry. Why? Because bookkeeper has limited knowledge. And because of that, senior accountant or the management advises the bookkeeper, you focus on routine transaction. Don't pass adjusting entry, accrual and prepayments entry. Leave that for the senior accountant. At the year end, at the end of accounting period, they will handle that. So when the senior accountant came and had a look at the trial balance, unadjusted trial balance we call this, he prepared the worksheet, he reviewed everything, and he came to know that, salary is 1,000 per month. So the statement of profit and loss when we will prepare, it will be prepared of this entire period. So expense that has been incurred in this entire period is of salary, 1,000 into 12 months. Employees have worked for 12 months. So 12 months salary has to go in statement of profit and loss according to the accrual and matching concept. So this is not right, 11,000. What we have to do, we have to pass an adjusting entry and we have to record additional 1,000 as an expense that will go to statement of profit and loss. That's the thinking of senior accountant. So let me just show you the adjusting entry which is passed by the senior accountant. See here what the senior accountant will do. Senior accountant will pass the entry. See, 31st March 2024 at the year end. Over here, what entry? Salary account debit. He has debited salary account, an expense account. Salary is an expense account, right? So it has debit balance. To record, he has to debit it. So salary account has been debited. An outstanding salary account has been credited. Outstanding salary is a liability account. To record that, he has to credit that because it has credit balance. Okay, fine. The senior accountant will do that. So then what will happen? Because of this, see here the salary account will be prepared. The T account of salary. Okay, salary account is an expense account. All right. So debit means plus, credit means minus. So first what happened? First, this guy, bookkeeper recorded salary has been increased, right? Salary expense he recorded and it was paid through cash, right? Salary has been increased. Salary account is getting debited because of cash. Okay, cash payment, right? Salary debited because of cash. Is it clear? That first posting happened and that happened by the bookkeeper. Then because of the adjusting entry, what happened in the ledger? Because of adjusting entry, see here salary account is getting debited. 1,000 additionally has been recorded. Salary is increasing. Okay, salary is getting debited because of outstanding salary. We have to pay salary. Is it clear? And then nothing over here, right? So here there is a gap. There is a balance of how much? 12,000. There is a gap of 12,000 shortage. So that shortage is the 12,000 which will hit profit and loss account, because that's what happens. We always close all expense and incomes account to profit and loss or to income statement, we also say. Fine. So 11,000 plus 1,000, that's 12,000. 12,000 on both the sides, and 12,000 minus 0, that's 12,000. So 12,000 will go to profit and loss account. Fine. So if you see in profit and loss account, here see 12,000 has come. Okay, it has come from over here. But when we see the questions, what do we do? When we see the actual final accounts or financial statement questions, what do we get in questions are, see, we get the trial balance. In the trial balance, they will give us salary 11,000, and below in adjustments, we call it additional information, they will say outstanding salary 1,000. Yeah, outstanding salary 1,000. Then what we do is when we prepare the profit and loss, we take salary 11,000 from trial balance, and then from additional information 1,000 outstanding they said, so we add it over here. Why it is added and everything we have understood just now, yeah, to calculate the correct profit and all. Okay, so 11,000 plus 1,000, 12,000. How it is coming also we understood. So what is the impact on profit and loss now? The impact is profit will be what? Decreased. If there is a profit in this current accounting period, then profit will be decreased because we have recorded an expense. This outstanding salary doesn't mean liability, huh? This is just presentation. Actually, it's expense only. 1,000 additional expense has been recorded over here. Is that clear? So because of that, what will happen? Expense is increasing. What will happen in profit and loss? What's the impact? Profit will be decreased. If there is a loss, then loss will be increased. Yeah. And then in balance sheet, what will happen? In balance sheet, you all know, we have to show this outstanding salary as a current liability over here because it's a current liability, right? So impact will be liability will go up. Yeah, the liabilities will go up. So when our stakeholder, yeah, investor, creditor, yeah, lender, whoever it is, our shareholder, when they will see our financial statements, then they will come to know, okay, this is the profit. Okay, whatever the profit or loss is, it will be accurate profit or loss, isn't it? Because we have considered this outstanding salary. Yeah, that's that expense, I mean. Fine. And in balance sheet also, when he will see outstanding salary is there, then that person will understand, the user of financial statement, the stakeholder, okay, this company on 31st March is accepting that, you know, they have to pay 1,000 salary. Maybe it will be a million, 100,000, who knows? I'm just taking simple figures over here. Is that clear? So this is the reason why the adjusting entries are passed. Adjusting entries are passed so that accurate financial performance and financial position is communicated in the financial statements, so that true and fair view of business is portrayed. Is that clear? Simple and straightforward. So this was the purpose of adjusting entries. Fine. After this, new accounting period will start. Okay, see here, new accounting period will start 1st April 2024. Okay, on that day, what you have to do, the senior accountant will have to reverse this entry. Here salary is debited and outstanding salary is credited. Exact reverse. Outstanding salary debit, salary account credit. Okay, first day of the new accounting period. Is that clear? Now what is the impact of this entry? Tell me. What is the impact? The impact is really simple. Outstanding salary account is over. Here it was credited, it was recorded, yeah, it was increasing. Now you have debited it and cancelled it off. Yeah, first you recorded outstanding expense by crediting it, it increased. Yeah, later in the next accounting period you debited it and you decreased it, so it's cancelled. But what happened to salary account? Salary account was completely finished in the previous accounting period because the entire balance was flown to profit and loss. Yeah, it went to profit and loss and it was finished. There was no more salary account. In the new accounting period, you are crediting the salary account. Why is that? Why? Because you're crediting the salary account because you need negative balance in salary account. You need negative balance because there is zero balance. You all know every year we restart the expense and incomes account with zero balances. Okay, so we have zero balance on the first day of new accounting period and we are crediting salary. Means what? Salary is an expense. It has debit balance. If you are crediting it, then it is decreasing below zero. It is becoming negative, negative 1,000. Okay. So why is that so? Because we need that negative balance. Let me tell you. See, then what will happen is, see, after reversing entry, the year will start. Yeah. March is over, right? So April, May, June, July, August, September, October, November, December, January, February, again March will come, right? So in this entire 12 months, what will be happening? Normal salary payments will be happening. Yeah, on 7th of April here payment was happened. Yeah, 1,000 payment was happened over here of this March salary, and then salary was increased. So from May, June, July, August, September, October, 2,000 per month was being paid, isn't it? Yeah, on the due dates, I mean. So see here, this is the entry in combination that would have been passed by the bookkeeper. Salary to cash, first 1,000 would have been passed, yeah, on 7th of April, and then April, May, on May 2,000 entry will be passed. Salary to cash 2,000, June 2,000 entry, yeah, July 2,000 entry, isn't it, on 7th. Yes, so in combination it will be how much? 1,000 previous March salary and then current accounting period salary of 11 months, 2,000. Yeah, 2000 into 11, isn't it? So 1000 plus 2000 into 11, this is 22,000, that's equal to 23,000. Now you'll wonder, sir, why not 12 months? Why 11 months you are taking? It consists of 12 months, that's correct. But understand, this March salary will also be paid in April, isn't it? So payment will not be happened in this current accounting period. I mean in this, right now we are in this accounting period now. Okay, this is past now, we are here now. Okay, so here only 11 months salary will be paid. Okay, as per 2000. Fine, that 1000 was of previous accounting period. It has become previous now, isn't it? So 2000 into 1, 22,000 plus 1000, that's 23,000. But there is a problem now. Understand, the problem is we have debited salary account in this current accounting period as 23,000. But you know, out of this 23,000, 1,000 belongs to previous accounting period. Sir, you said according to matching concept, we have to take the expenses which have been incurred in the current accounting period. So this 1000 has been incurred for previous accounting period. How can we take this salary value in this current accounting period? Yes, we can't. That's why reversal entry was passed. By the reversal entry, 1000 has already been credited over here. We have a negative balance of 1000. We have negative balance of 1000, and here you are debiting normally. I mean, bookkeepers are doing that. Yeah, they don't know. They just see salary has been paid. Okay, fine. Just debit the salary to cash. That's why reversal entry is required. Yeah. In normal accounting process, to streamline everything, to make everything simpler, we need reversal entry. Is that clear? So we had negative balance over here. Even though the junior accountant or the cashier is debiting salary, still it won't be any problem because we already have negative balance and it will be nullified. Is that clear? Fine, simple and straightforward. So this entry will be passed, and because of this, what will happen in trial balance? What will appear? See, in trial balance, unadjusted trial balance, what will appear is 22,000. Only 11 months salary, 2000 into 11. How so? How? Because see, salary was first credited, so negative balance was there, and here salary was debited, right? So 23,000 minus 1000, that's equal to 22,000. So 22,000 will appear, which will be correct. 11 months salary has been recorded over here. Yeah. But when senior accountant will come to prepare the financial statements at 31st March 2025, what will happen? He will see salary was increased to 2,000 per month. So of this entire year salary, according to matching concept, according to accrual concept, it should be how much? 2,000 into 2, that's 24,000. Yeah. Employees have worked for entire year, all 12 months. Every month they should be paid 2,000 per month. So that's 24,000 per year. Salary expense have to go to statement of profit and loss. But when I see this trial balance, I see over here bookkeepers have just taken 22,000. So he easily understands that March salary is not paid. It will be paid in April. That's why the difference is there. So 2,000 adjusting entry I will have to pass. Is that clear? Do you understand this? Yeah, it's 22,000. It should be 24,000. Yeah, so 2,000 adjusting entry he will pass. See here, adjusting entry, it's really simple. 31st March 2025, yeah, year end of this accounting period, right? Here he will pass the adjusting entry as, see, salary account debit to outstanding salary. Yeah, 2,000. This is the adjusting entry. Fine. And then we have to prepare the T account. In T account only we'll understand everything properly. See here, in T account, what will be happening? Salary account to cash. First, what happened? First, he paid, na? Who? I mean, the bookkeeper recorded the payment of salary to cash, 23,000. So we have to take that in the T account. Salary is getting debited because of cash payment, 23,000. And then see, reversal also happened. Yeah, because of reversal, also salary account got credited over here by 1,000. So salary account got credited because of outstanding salary, reversal 1,000. We call this as opening balance because this happened on first day of the accounting period. Fine. And then see here, salary account got debited because of outstanding salary, isn't it? Salary account got debited because of outstanding salary. Yeah, 2,000. And this happened at the year end. So we call this as closing balance. Fine. So this is the thing. All right. So now if we try to balance this account, 23,000 plus 2,000, that's equal to 25,000. This is the bigger side. So write that amount on both the sides, and 25,000 minus 1,000, that's equal to 24,000. This balancing figure, this shortage will hit where? This balance will hit profit and loss account. That's what happens now. Salary accounts, yeah, is an expense account. Expense and incomes accounts are nominal temporary accounts. They always get close to profit and loss account. Okay, so this 24,000 has to go in profit and loss account. See here, it's correct now, isn't it? 24,000 is the correct salary expense for the year, 2,000 per month. So 24,000 salary expense has gone to profit and loss. Okay, is that clear? But when you do the financial statement, what happens? You get the trial balance 22,000. Below in the adjustment they say 2,000 is outstanding. So what do you do when you prepare the profit and loss? You take first salary from the trial balance 22,000 and then add outstanding salary which was given in the additional information 2,000. So that's equal to 24,000. Is it clear? This is what you do, right? And then in balance sheet, see here, in balance sheet what will happen? Outstanding salary 2,000. This is the current liability which will appear, right? Here you credited now, so that will come over there. Is it clear? On the liability side, you understood this? Okay, so correct financial performance and correct financial position has been communicated to the users of financial statements, yeah, our stakeholders. And then after this, in the next accounting period, yeah, on 1st April 2025, what you have to do as a senior accountant? Immediately you have to pass the reversal entry. Immediately you will have to pass the reversing entry or the reversal entry. 1st April 2025, first day of the new accounting period, yeah, exact reverse of this. Outstanding salary to salary, 2,000, 2,000. Is it clear? Fine. So in the new accounting period, again you will have negative balance and the same process will continue. Is that clear? So you have understood right now how it all works. Okay, it's really simple and straightforward, isn't it? So now let me tell you the shortcut of preparing this T account. Okay, always payment will come on the debit side. Is that clear? This is the format of expense account. Okay, whenever there are adjustments of outstanding, prepaid and all, see what you have to do, understand, payment will always come on the debit side because expense is increasing and you're making the payment. Fine. Okay, and then outstanding salary. What is outstanding salary? Outstanding salary is a liability account, right? Liability account has credit balance. You know, whichever account has credit balance, when we prepare the ledger account of that also, what happens is opening balance will be on the credit side, closing balance will be on the debit side, right? So that is what you have to remember and take it like that. See, opening balance means because of reversing entry it happens on the first day, right? So this 1,000 came over here. You see this? This is the opening balance because of reversing entry. It happens on first day. And then because of adjusting entry, we have closing balance, outstanding salary 2,000. Yeah, it happens on the last day. Yeah, so it will come over here. Yeah, the shortcut, you have to remember this. Okay, and profit and loss will always come on the credit side over here. Is it clear? Okay, so this is the shortcut. So let me just show you the format of this expense account. See here, the format of expense account will be like this with max adjustments of accrual and prepayment. See here, expense account, always cash payment will come over here as you saw, cash, yeah, cash or bank, okay, whatever it is. And then profit and loss always here on the credit side. And then outstanding expense is a liability. Remember that. Outstanding expense is what? It is a liability, isn't it? I told you, outstanding expense account is a liability. It has credit balance. Okay. So credit balance means opening balance on credit side, closing balance on debit side. Okay. This happens because of reversal entry. This happens because of adjusting entry. Fine. And then prepaid expense we'll discuss in the next video. Prepaid expense is an asset. So opening balance on the debit side, closing balance on the credit side. Why is that so? Because it has debit balance. Asset has debit balance, right? So opening balance on debit side, closing balance on credit side. So you take all the values over here and then you immediately calculate the balancing figure, how much will go to profit and loss. That's the main idea. Okay, that's the main concept. How much will hit profit and loss? Okay. So because of that, we prepare these T accounts. See, we found out 24,000 should go in profit and loss account as a balancing figure. Is it clear? So this is the whole thing. Okay, it's really simple. It's not difficult. Okay, I will upload the PDFs in the Telegram group and you will be easily able to, access that. Fine, and read properly how it all is happening. Fine. Okay, so I hope you have understood the concept of outstanding expense and that practical example of how it all works. All right, so that's all for this video. See you in the next video. Bye.